show a million of them, and tell me if I am not correct in this. You can show them doing 1,000 different freaking things. At the end of the day, that policy is going to perform in whatever it is they're going to put into it. So it's not about the illustration or the 10th year or da da da. It's about the process of understanding the banking process, putting the money in and out. Every year to year, we'll look at an in-force illustration and we'll see how it's performing, but you got to be careful. Now, if you want to continue to do it your way and continue to get your results, go right ahead. I'm just telling you, I've seen you use an illustration to a point where it's hurting you instead of hurting because then they get married to that illustration and they study that illustration and then they question you on that illustration. I don't want you to question me on that. I want to talk about the process of banking.
Well, I found that I've talked about the process of banking with a lot of people, and most people, it's just they don't understand it.
You know, your way.
No, I'm not.
I'm just trying to give you some. I'm trying to make you understand that you keep referring to. I take him to year 10. I take him to year 10. I take him to year 10. Okay, that's not the answer.
Well, see, when I do show an illustration, I mean, I don't bring. Some people want to see it, and if you don't show it to them, you could come off like
a charlatan.
Okay,
yeah.
You're hiding something.
Yeah. So in those cases, I think I have to. But what I tell them before is like with banking, and I write it out. It's 25% product, 75% process. The product is a policy. The process is how you use it. So ours kind of try to plant that seed before I show them the numbers. And when I do show them. At year 2, you have about my older ones. They're not getting 100% in year 2. But look, you almost have all your money in year 2. Then I do go to year 10 and say, no matter what your age, you're typically getting 50% of increase over your premium.
Yeah, we got Mel and I got Berto. That was a client that wanted an illustration. And we told them, don't get married to this illustration because first of all, the funding was between 30 and 100. We're not even happy, so we're just going to do a middle 50. We don't even know if you were actually going to put that, right? Well, sure enough, takes that illustration to his CPA and tears the illustration up as if that was the
be all.
It's just a sample. It's just to show you how we could run these. I can't answer that question because I don't really know I don't know how to settle the bank, and if you don't tell me what your fund is going to be to really be, you see what I mean? It was just horrendous.
Well, the thing is, I always give the example of one that I've already done. I like to show them how how the client is using it to do different things. Because so when I talk about the process, and so I talk about process, and then I give an example of what I've done for somebody, and basically my guy, the X-ray technician that had a bunch of money sitting here, and he had $50,000 in a Bank of America savings account. He had a $20,000 car loan at 8% with Bank of America. And so when we're talking about the banking, where did Bank of America get that money to give you a car loan? Well, they got it from your savings account. So why are they paying you next to nothing on your savings account, but over here that same money that they just went into your bank account to get for you is worth 8%? And then we talk about, I say, well, we took the money, we opened up a policy. He had immediate cash value of 28,000 out of 34. We took 20 out. We paid off his car loan. We took the same payment, the $567, and we just rerouted that back into his banking system.
Is he still making the car payment?
Yep. And he makes that payment religiously, like you say, Anthony. Did we change it? Did I change his cash flow at all? Did I ask him for any extra money? No, we just rerouted a payment that he was already making back.
And that's what you need to highlight. That's what needs to be highlighted. Not the discussion over how much the first few years of charges and fees.
Well, sometimes people ask me, what is the downside of doing this?
And that's what I tell them, because when if I have to show them the illustration, they go, well, in the first year I'm losing this.
Well, I still don't show them the illustration,
okay.
Or say in the first year, I go a lot of the biggest downside. Oh, I tell people, look, you can walk away from this at any time, okay? But if you do that, maybe between year 5 and 7, you may walk away with less money than
But that's an
what you put
investment
in.
that you do, really, when you think about it.
And that's
you
what.
can do an annuity, there's surrender charges, you can
Yeah,
do.
but then I would say, are you in this for the long term or short term?
I think that's the biggest question I've gotten. People are like, well, what happens if I want to stop, putting
Why would you
premium?
want to?
Because I tell people, like, look, there's only one thing that you have to do to keep your bank running smoothly, and that's make your premium payment.
See, and
But that's the thing, in the minute that you say the word premium payment, see, you can't, I have a very big thing about, making this is not a debt.
Mhm.
This is not incurring
not a
a debt,
payment.
it's not a payment,
Yeah.
this is,
So it's a savings account.
well, not even that. I mean, this, to me personally, I feel, what I want them to walk away with, this is a process.
Mhm.
It's the exact same dollars, just flown in a different direction. So, and I just talked to one of Marlon's clients today. I mean, he took out, same deal, he's ready to pay, and now he's all freaking out because he's thinking that he can't afford the payment. I'm like, okay, but you just cleaned up debt. So they just paid off $400 a month in debt, and they're afraid to put the $400 back into their account.
No,
I mean,
they
that's
don't
like the
understand- they don't-
norm,
they
that's
don't
not the
understand-
exception,
No,
right.
but they don't understand it, and, because I had somebody ask me the same question, like, well, Brittany asked me that yesterday, she's like, well, if I take out $25,000, why do I have to put the $25,000 back? And I'm like, you don't have to put it back, but you should put it back. We encourage you to put it back because it's just like a savings account. If you take the money out, you have no more money left to use.
He was rebuilding.
The quicker you put it back, the quicker you can use it again. Sorry.
Because I gotta leave at 3:30.
Oh, my bad,
Go ahead,
sorry,
go ahead.
finish.
Okay, so, and a lot of times I won't use premium or say premium deposit.
Okay.
But, so, let's see. So in essence, where we were,
Mhm.
we did another premium deposit, 20,000.
Okay.
Took out the 17 plus the 13. With this 30,000, we paid off with some more debt. Now we've recaptured 36.25 a month. Okay, we continue to put that into our account for the rest of the year. Okay, now it comes time to make our third premium deposit. This year we put in 20. Now we're able to take out 18.
Okay.
Okay. Now in our separate account here, we have 43,500. Okay, we add that with the 18, and we have $61,000. So now we can completely pay off Sears now, pay off First Bank Trust, pay off JW Practice, pay off another First Bank Trust, and pay off Ray's loan. More importantly, we recaptured this 637, this 427, this 535, this 495, and this 300.
Anthony, I have a question.
Yeah.
Are we making any repayments back to our policy?
Not yet.
Oh, okay, gotcha. That was
So
just
kind of what, no,
question.
that is a good question. Right now, our phase one is to stop paying interest to all these banks.
Gotcha.
It goes $420,000 and $7,500 a month. When our goal is to stop that going to other people and to start going to you.
Okay.
Okay?
So we're just letting the interest accrue on the outstanding loans on the policy.
And I'm going to show you how that looks like at the end of the day here in a second.
Okay.
It's pretty amazing. Now we've recaptured almost $6,000 a month.
Okay.
Now, some of the typical financial advisors just focus on building assets, right? But we also want to manage our liabilities. After 25 months, we've paid off $161,000 worth of debt, and we've freed up $5,775 a month. That's not a year, that's a month. So how do you think these guys feel? 25 months in this program,
Elated.
right? And now they only have 2 vendors now. It's only on their mortgage, and they've recaptured almost $6,000 a month. So what happens if there's another financial crisis? Or maybe he wants to buy another practice. Or maybe their daughter has some medical issues. and there's always a maybe out there.
Mm-hmm.
Or what if they couldn't make their premium? Okay, maybe when the 20,000 comes due, they don't have enough money for their premium deposit. Couldn't they use some of this money that's in our separate account here to pay that if
Sure.
they needed to, right? So in this example, in this case, after 37 months, we paid a premium deposit of 20,000. We're able to take out 19, and plus the 69 that we have in our separate account. That's $88,000. And now we are able to completely, after one more month, we've completely paid off the house. So now their only debt 38 months later is one mortgage. Now they freed up 65.25. Now are they working any harder?
Nope.
Have we changed our cash flow at all during this?
Nope. It's held for 20,000 premium payment.
Yeah, it's just money that they were saving somewhere else.
Mm-hmm.
Now they have control of it. And so all we're taking is the cash flow that was going to these outside banks are now going to their bank, right? So we continue this for the rest of the year. Now here, what you're going to see is this 20,000 for this policy. We dropped the premium deposit to 8. And the reason, well, when you're working with this, we will go into more detail later. But the longest you should wait to open up your second policy is going to be after year 4. Okay, and one reason is they can put in 8,000 and they can take out 93.15. So if you could pull out $9,300, how difficult would it be for you to find $8,000? If immediately
I got it in my pocket right now. You help me out?
Perfect. So what they do is they start another policy for the same amount. Okay, and now they can pull out 11,190.
Okay.
Now they have $71,000 in their separate account.
Okay.
So they take this and they pay down their mortgage. Now a few months later, they have enough money in their separate account of $53,000 to completely pay off their last debt. What do you think?
Sold.
How long was it that it took them to pay all of that? 35 months, is it?
57 months.
57 months.
Okay, now
That's just the beginning.
that is just the beginning. That is not the whole story. And this is one of the many reasons why we like working with families. You see here how they did this in 57 months, right? What we're going to do is project that in the future. Now here for house 2, they had 334 months left, right? Okay, and how long did it take us to pay it off? It was 57 months, right?
Yep.
So if we subtract 57 from 334, it's 277. So if we just multiply their payment, which was $751, to $277. So this is just money that was going to the bank, is now going to their bank. And then if we do that for the first, the payment was $1111. You see how there was 274 months, right? But we paid it off in 57.
I think you need one more one. Thank you.
I get so excited when I'm talking numbers.
You're a CPA.
I know, I
get it.
know. So at 274, we subtract out the 57 months, right? It's 217. So again, I thought that was a little high.
I was like,
Sign me up. I want another one. So here, with that, are we changing our cash flow at all? We're working any harder?
Nope.
We taking on any more risk? All we're doing is taking that money that was going to an outside bank is now going to your bank, right? That is $450,000. Now that would be cool, but if that's where it ended, but there's more. What if they put this in a policy that was growing at 4%? Now those numbers are about $783,000, tax-free, and they own the house free and clear. It's really amazing.
Why would be more people like it? Doesn't it amaze you how some people just don't get it? Or let me say this.
If you look, I mean, if you look,
Like,
if you look at the ability just to go on your point, I mean, think about Brittany and Duran. I mean, right now they're probably making about, I mean, they're going to make probably close to $300,000 this year, and they have no expenses hardly.
Right.
Like, why, and you're 30 years old, I mean, why wouldn't you be all over this?
Where's their money going?
In the bank, sitting in, like literally sitting in the bank. They're like, oh, we just want to see big numbers again.
Cool, so put it in this and see big numbers. What the hell's wrong with you?
They need to buy a new Tesla. Okay, go.
Okay, so Walter, I'm not sure if we address all of these questions yet, but unfortunately I have to go to my next my next meeting. Now, would you like to know what the next step is?
Yes, please.
Okay, all right. So as we discussed, and you read the book, this is life insurance.
Okay.
Right?
Yep.
And so you've had a mortgage before,
Mhm.
right? So when you were shopping for a house and you needed a mortgage, what was one of the first things that you did?
Just checked out different companies, interest rates, look for different rates.
Well, we have to get pre-approved, right?
Yeah.
Because maybe there's something on your credit, or you need to figure out how much house that you can afford, right? So we need to do the same thing here with your life insurance. Okay, so here's what the process is. First thing we do is we schedule an exam. Now we will send a nurse or a doctor to your house. They're going to draw blood. They're going to do a urine test. They're going to ask you some questions. Okay, and then we'll have Becky call you and do a application. Now again, she's going to ask you some more questions. That probably takes about 15 minutes. Okay. Once we have that, then we can submit.
Okay.
Okay. Once it's submitted, the insurance company is going to get your motor vehicle report. They're more than likely are going to ask some information from your doctor. You don't need to do anything. They're going to contact him or her directly just to get some information from your records. Then there'll probably be a phone interview, which they're going to ask the same questions that Becky did on the app and what they did on the exam.
Mm-hmm.
Okay, and then once they have all the information, we will have approval. Once we have approval, we have 2 weeks to either accept it or say thanks, but no thanks. Now, once we submit it, this process here typically takes 3 to 8 weeks.
Okay.
A lot of it depends on the doctor. The doctor plays nice. We can get this turned around sooner. So during this time, we will continue the education process. We can make sure that we answer all of your questions. I can show you some more examples. We have a pretty cool car example where we can show you You could recover the costs of all the automobiles that you purchase. And during that time, you will have enough information to determine if this is for you or not.
Great.
Okay, perfect. So when's a good time for Becky to call you to do the exam, to take the application?
Usually anytime, but let's say around lunch. I usually have 15 minutes for, when I'm grabbing my lunch, she can give me a call anytime.
Okay. What day would work better?
Tuesday or Wednesday.
Tuesday or Wednesday? Okay, perfect. Now, I know we didn't get to all of your questions. Why don't we schedule another meeting in about 2 weeks, and we can go over these questions.
That would be great. Actually, can we do it a little bit sooner? I'd like to, have some questions maybe a week and a half.
Sure. Yeah.
Do you usually do 2 weeks out here? I feel like that's kind of like too much time.
Basically, if it's 1 week until they're in underwriting,
Yeah, that's true.
and then once they're in underwriting, I try to do 2.
Okay.
Because sometimes you can have, like, what are we talking about? I mean, if you meet every week, it can.
That's true. Yeah, too much. Okay.
Yeah.
Guess that's what happens when you have a lot of free time like I do. You try to stay in front of people's faces.
Well, also, you don't want them to know that you have that much free time.
That's true.
All right, guys. Feedback.
Okay, so very quickly, some of you gotta go. 2 things. One, I still feel like there is room for some personalization and some,
Yeah.
a little bit more of getting to know. I still don't think that you know who Walter Brown is.
Well, in this scenario, it's kind of weird to start asking some personal.
So I think that every appointment needs to have some type of personality.
Oh, I know. I know what you're saying. I mean, I do, and that's one thing I took away from the last time that we met. And even with the Sandler, it's building that rapport.
Yeah. And the second thing that and this just comes from being a life insurance agent for so many flipping years, is I think that there is a missed opportunity to really talk about the value of the benefit side. I think that the banking system is greatly highlighted, and I get all that. But at the end of the day, the true star of this equation is the death benefit. Is the fact that if you die tomorrow, all of your debt gets wiped out because it gets deducted. So you don't leave any outstanding debt out there. I think that's important to point out. I think it's important to point out that it may or may not fulfill the needs of the family, like mine, small children. Is this going to be enough? Probably not. So we'll talk about maybe some long term, an opportunity to talk about more death benefit.
Really, what I would do is I'd schedule a meeting in a week or 2 to start discussing more details. Like, I didn't get to his questions. There's some other things I might show about rates of return.
You do talk about death benefit at different meetings in more of a death benefit discussion than the banking discussion.
Yeah, I talk about the MEC line and how we design the policy. I don't go numbers, but.
But I'm not talking about banking. I'm talking about the value of death benefit.
In his defense, I have done a meeting with him where he has talked about it.
Life insurance as a
Matt
death
Fowl.
benefit, now as a banking.
Well, if somebody doesn't have, I mean, this client didn't have anything.
Anything.
So that first meeting, I typically don't push to go into underwriting unless I get the feel
Who did that?
that they,
My ankle.
Holy jeez.
unless I get the vibe that
Okay.
they're on board. But in the case, like, he didn't have any death benefit, he's married, 2 kids.
Because I'm going to tell you the number one reason, and the reason I say this is because I see the lapses that come through and I get talked to the clients that no longer want the policies that we have set up as banking, and 99.9% of the people don't get rid of them because they were banking policies. Their thing always is, well, I just don't want a life insurance policy anymore. They, at the end of the rainbow, they go back to, I just want to make sure that through every single process, the life insurance portion is equated in importance with the banking equation, so that.
Well, I think the important to point out is that this addresses their pain, and that this is why they need to do it to address their pain. I don't have a lot of people aren't really concerned about death benefit.
You haven't been in the business long enough, you'll see. Because the thing is, when they get, the Ameritas doesn't send communication as a banking system. America sends communication to them as a life insurance policy. And as the years go and as their terminology, it's geared towards life insurance as opposed to premiums, as opposed to banking. Because you gotta remember, at the end of the day, this is a life insurance contract. And when they get their first statement or their second statement or their third statement and they start, you know, as the years go by, then, and I'm not saying everyone, what I'm saying is that I think that it's just as important to make sure that they're aware of the parallels between the great things, the positives about having death benefit along with the banking system. But that's really that's gravy on your, you know what I'm saying? That's, having that death benefit just makes it all even better.
Well, I wonder if it's because you've been in life insurance so much. I'm not sure if the average person realizes the power of the death benefit.
We'll have a conversation in a few years from now when you'll see some of the people's loans after they've paid, once they get done funding and they pay everything off and they start repayments, that's when you're going to start seeing what I'm talking about. Because the repayment phase, for whatever reason, doesn't seem as exciting as the payment phase. And that's where, and you'll see. My point being is that, take it for what it's worth. If it were me, I would always emphasize just as much the death benefit. You see my presentation. You talk about the death benefit as important as the banking equation. Because without the death benefit portion, you can't have banking.
You know, one thing I would have normally done, but because of the time when I forgot, is I would go through the notes of our last meeting. So then I would talk about their pain. Is anything else changed? Just try to make sure we're clear. And then our just kind of.
Those are the notes from before?
Pardon?
Yeah. Those are the notes from before.
Yeah, then I will clients forget almost all this stuff.
All the time.
So even though I email to them, I don't know how many look at it, but a lot of times they have a question and I may pull this back up, but you know, particularly the 4-6 calculator, every time I meet with them, I'm showing them, okay, do you remember that we can earn more interest even though we're paying at a higher rate, and just to make sure that that is embedded.
The number one thing that I hear most of the people that call that either have questions or we service or whatever are, for whatever reason, they hardly ever know that the cash value gets added to the death benefit. They think that the loan's going to be deducted from their death benefit.
Well, the loan is going to be deducted from their.
It's deducted from the face value. Do you know the difference between face value and death benefit value?
Hold on, I don't.
What are you talking again?
I recorded this.
No, Anthony, there's a big discrepancy between your face value and your death benefit. So.
Well, the face value, but your death benefit increases each year.
That's my point.
Right.
That's the piece that they keep forgetting. They think if I have 100 and I owe 20, I'm only going to get 80. That's the piece that they forget that it's added to. It becomes death benefit. Because that's another thing. What if I die and I have all that money in cash value? It becomes death benefit. That's the piece that I'm talking about, where you highlight the death benefit side.
See, and that's everybody that I hear that talks bad about whole life. They say, well, if you die, all that cash value that you get, you don't get any of that. You only get the death benefit.
That's good. Right.
Yeah.
That's
That's if you set up. That's if they have set up like a option A.
Well, that's universal. Whole life doesn't have those options. Whole life pays out. Whole life is whole life. It's universal that has the A, the B, blah blah blah. So. Yeah, good. Thank you so much.
Thanks, Anthony.
No problem, John.
I learned some things. Everyone learned something? I learned that those.
So when will this be available?
Huh?
When will the video and your notes that you took on your
You guys look at the video.